So hello and welcome to the Mercury Book Club author interview series. My name is Marco and today I'm joined by two very special guests, Jonathan Shapiro and James Eyers, who are co-founders of our book of the month for August, Buy Now, Pay Later, The Extraordinary Story of Afterpay. Welcome both.
Thank you. Thanks, Marco. Thanks for your interest. Yeah.
Thank you. So today I'm looking forward to speak to you both about the book and uncover some of those key insights that you discovered while researching the book and of course discuss all things Afterpay. So to kick it off, I'll just pass it on to both of you just to give a quick summary about your background and then perhaps an overview of the book as well.
Oh, look, I'm James Eyers. I covered the banking sector and increasingly the buy now, pay later sector at the Financial Review. I've been a journalist for almost 10 years. I started covering Afterpay soon after the company listed on the stock exchange. It was probably a couple of years after, actually. I didn't get onto it at the time of the float, but as the company got a bit bigger and started to hit a few speed bumps in terms of regulation and the like, we started to have a pretty close look at it. So it's first book that I've written, and it's certainly been a great ride.
Yeah, I'm Jonathan Shapiro. I've been at the AFR slightly not as long as James. I think James is part of the team that I joined back in 2009, which is to cover deals. And I cover hedge funds, investing, markets. I've got quite a broad remit at the AFR, also financial services. And I kind of was fascinated by Afterpay or kind of came on my radar. Firstly, because it was such a divisive kind of small cap company that a lot of these hedge fund analysts that could go long or go short were kind of mulling over which this business model and whether it's sustainable and whether you should own it or short it. And it became like this really divisive stock. And then also my wife kind of picked up on it on the online shopping. So that kind of added it into the mix. And I guess I've probably got a similar story of Afterpay than as a lot of people, which is they've seen it in the market, divide analysts, but they've also seen it in the real world, kind of either attracting kind of lovers and haters. So myself and James have followed the Afterpay story, and it kind of reached a point after that kind of COVID fall collapse and then rally, where we both kind of looked at each other and thought, wow, this is actually an incredible Australian story, you know. And if ever we're going to write a book, this is the company we need to write about. And we both kind of had different experiences and different angles looking at it. And we kind of felt that if we joined together, we'd be able to paint this really interesting picture of Afterpay as a retailer, as an investor, as a fintech innovator, as a divisive stock, there's so many, the politics and regulation around it. And we just thought there's this really fascinating mosaic about a startup, but also about Australian finance, Australian banking, and the capital market. So that was kind of our motivation for writing this book.
Yeah, of course. And so would you say it was around that kind of post the first kind of set of lockdowns in Australia that really motivated you to write the book?
Yeah, I think it was. It was. You have to take yourself back to March, April. So when the coronavirus sort of first hit the market, I mean, Afterpay's stock dropped 75%, lost 75% of its value. It's at $8.90 on the ASX, and sort of roared back to $130. I think it's trading at now. And when we saw that, I mean, people were really scared and fearful at that time. And there were some existential sort of questions in March and April 2020 as to whether or not the company would even survive. And I know the company's investors were asking those sorts of questions of the founders. So we watched that, but then it just came roaring back, and it came roaring back really hard on the back of this sort of switch to e-commerce that the lockdowns prompted. And the stock was back quite quickly. Tencent, the Chinese tech giant, invested took about a 5% stake in Afterpay around May, I think it was. So we saw that, and Johnny and I sort of started talking to each other about the book probably about July of 2020, and decided it's something that we really needed to do.
Yeah, and James is right. It really was existential. I remember like in March, April, kind of when we were all, it was a strange time because we're in lockdown now, but we're not as terrified as we were. It's more familiar to us what's going on. that March and April was a very terrifying.
Well, there was no vaccine around the corner then, was there?
And we didn't know how bad it would be. And I
Yeah.
just remember thinking, gosh, is Afterpay and Zip going to be like the Alco, Babcock and Brown of our generation? You know, this kind of millennial twist on credit-fueled exuberance that's just going to like get blown up at the first crisis. And I was quite worried that it would be. And then it turned out to be the complete opposite. It landed up because those kind of brands became triumphs of this new era. And pandemic was almost like the blossoming of e-commerce, and that for me was a realization that, you know, like if COVID was the kind of event that if you could have designed an event to destroy these businesses in a way that many people thought that would destroy them, it would have been something like a COVID, a lockdown where you know the kind of flexible workforce, you know, is cut off from their incomes and capital markets seize up. That would have been it. But yeah, I mean, there were a few things that worked in their favor, like JobKeeper and the recovery and central banks and everyone riding to their rescue or to the rescue of markets. But but they survived, and there were sound reasons why they survived, in addition to some that luck. And then that just kind of rounded the circle for me, at least, that this was kind of a great, an interesting company that was here to stay, and also a fascinating story of many twists and turns. And this was just probably the most dramatic twist and turn. So, as a story, we needed no more convincing.
Yeah. So, as the book discussed, Afterpay wasn't necessarily the first to market in this buy now, pay later space. So, what do you think made Afterpay such a strong player in the space? And do you think we're a little bit biased because we live in Australia and it's a tech startup? So yeah, I guess what do you think makes it such a strong company compared to the other competitors?
Yeah, no, it's a really interesting question. And I mean, we trace the history of lay-by at the start of the book. So I mean, you actually go right back to the 1920s and the 1930s, and you've got some installment payment products that were being launched by retailers, so to encourage consumers to buy, you know, more goods in department stores and the like. And some of those charged interest, but some of them didn't. And you know, there were products like Transacts and Certegy that we sort of uncovered that were doing something very like Afterpay in the early 2000s.
Very similar.
It was basically the same product construct. So it was sort of, you know, what didn't you have then and why didn't those companies work? I mean, I think a lot of them were focused on, you know, slightly larger goods. I think Freedom Furniture was one of the first companies that used Transact. So people are buying $3,000-$4,000 couches. They also didn't have, you know, the smartphones that arrived, you know, when they did to such prominence. I think Afterpay was very, you know, it was lucky in a sense, in terms of the timing of the technological advancements that happened. People were starting to do a lot of online commerce on their computers and increasingly on their mobile phones. It sort of rose to prominence also on the back of some, you know, shifts in thinking about the banks and you know, how trustworthy are the banks and what do people think about the credit construct and the credit card product that had become, you know, quite popular in the 70s and then less popular in the 80s and then more popular again in the 90s. I think Afterpay arrived at a time when the regulators were on the back of the credit card and concerned about the 20% interest rates. And then, you know, questions started to rise about the banks and, you know, are the credit card sort of a sneaky construct? Can you really understand it? And is it proper to sort of, you know, buy things on debt that you can't afford and revolve that debt and just pay the minimum balance to kick that down the can? So I think the Afterpay product construct was a little bit different to the credit card, and then it allowed the users to sort of take initially a small amount of credit, and that grew with the behavior over time. You know, unless you were late, there are no hidden fees. But merchant funding the product rather than the consumer funding the product was actually the flip. And you mentioned all of those competitors. I mean, there are so many of them now, Affirm and Klarna and Zip and all these companies. But all of those companies sort of started with a traditional credit construct. You know, there was interest as the basis of those products. And they did the digital onboarding very well in the sort of fintech way, but they were still effectively a consumer-funded product. Afterpay flipped that, let the merchant fund it, and those other companies then sort of followed. I think so. I think it was the timing was beautiful.
Yeah, I mean, the only thing I'd add to that is I agree with James. The timing was perfect. It was like the right product at the right time, targeting the right demographic. I don't even think Afterpay realized themselves, like when we go back to how well it would work. It was almost kind of by accident that they stumbled on this pay in full, and I just don't think they realize how powerful it would be, and what they stumbled on in their pitch to merchants to onboard Afterpay was that this is a win-win for your customers. You know, you can be seen to be the good guy, and it just became like this self-reinforcing thing where everybody was winning from, you know, using Afterpay. The merchant was paying the fee, but they were getting the sales. The customer was getting free interest, effectively. You know, free money, but free. You didn't have to pay for the fund for borrowing the funds. And Afterpay was growing customers and earning a fee. So it all just kind of worked, and it just became exponentially. The growth became exponential, and they did do a very good job of maintaining their brand, you know, and they built this very strong connection with their customers and this network effect. And it's just the right time, and they executed it well. It was just the right product at the right time at the right place, and it just worked spectacularly well.
Yeah. So in the book, you discuss this credit pendulum, you know, that swung through installment and cash orders, and then to lay-by through the Great Depression, and then onto those credit schemes and major retailers, to credit cards, and now buy now, pay later services. So over the next few decades, how do you see this credit pendulum swinging, especially since, as you bring out in the book, millennials and Gen Zs, they're not looking at credit cards? Do you think that buy now, pay later services will overtake credit cards in the future?
Well, they've got a long way to go. I mean, I think that the overall buy now, pay later sector, in terms of spending, is about 2% of spending. And, you know, let's say, I don't have the numbers right in front of me, like the straight debit card might be kind of 40-50%, you know, credit cards 30-40%, and all other, you know, payment methods, of which buy now, pay later is one, you know, small on the overall scheme of things. So they've got a long way to go, but I think the construct that Afterpay, developed first is now being mimicked by not only the companies that are competing against Afterpay, you know, the likes of Klarna and Affirm, which we mentioned before, but, you know, traditional fintechs like PayPal, and especially the banks. I mean, we've seen Commonwealth Bank quite recently launch Step Pay. So it's basically a buy now, pay later card that's going into the digital wallet that allows the user just to, okay, I've got a credit card option, I've got a debit card option, I'll now do the pay in 4 option. So it's certainly on their radar. You know, will it catch up to credit cards? I mean, I don't know. I don't think so. I mean, the credit cards are also responding. I mean, the banks have launched, both NAB and CBA have launched no interest credit cards. You know, and they're now grabbing quite a big share of the new credit card volume. So the banks have realized that the customers don't like the interest construct. So how do we respond? And the strength of that response, Johnny, like it's been so strong across the world. You know, and this is one of the themes that we explore in quite a bit of detail in the book. The competition has been so fierce and responsive that perhaps at some point that pendulum does swing back to the regulated banks.
Yeah, it's such a good question, but really hard question. And I just think back to maybe would have been 2013, 14. I was at this TechCrunch conference, and there was some tech entrepreneur. I think he was one of the guys associated with one of the rappers, and he got into tech investing. He made this comment that he's like, wow, this payments industry is so ripe for disruption. Like the amount of money being made for providing very little service, you know, facilitating a payment is way too high. And I guess that's in two ways. One is like the fees, you know, like the credit card fees, the interchange fees and the merchant fees. And the other one was just the cost of interest. You know, a credit card is quite a high cost of interest, and a high return on equity is very profitable for the bank. So they were probably payment providers were probably earning, and the credit card lenders were probably over earning. And I think buy now, pay later is one of the first or meaningful kind of attacks or disruptions on that over earning, and it's shaking things up. And I mean, I'm way too narrow-minded to be able to see see the future, but I think if you buy into what Square and Afterpay are saying post their merger, is this they're going to create this like bigger ecosystem where they can be these very big, powerful companies by not necessarily charging you a huge merchant fee or payment fee and big interest. They can just be a big ecosystem and be a very kind of big, profitable Amazon-like platform for facilitating payments between merchants and customers, and they'll find their own way to extract the economics of this ecosystem, and maybe that's where payments goes, and it does disrupt it and kills the kind of over earning, or reduces the kind of super profits from what was going on before. That's kind of how I would, if I was trying to be
I think that's absolutely right, Johnny. But I think that the pay in full construct, I mean, that's almost becoming like a commoditized thing. As I said, banks can offer that, and everyone can offer that. Where the action is who can create that ecosystem with a large enough number of users that can drive real incremental value into the merchant. So Afterpay's got 16 million users and built that user base up because of the simplicity and beauty of that pay in four installment model. But now it's got those customers. It combines with Square that's got something like 90 million users. And then all of a sudden you've got a meaningful pool of daily users that you can then shove into the retailer market and drive their incremental sales like an ecosystem does. And I think the pay in four option becomes one of many different payment options that everyone's doing, and it's not necessarily something that you can distinguish yourself with.
So interestingly, a few days before the book was published, Square announced its acquisition of Afterpay. So I'm curious to get your thoughts on, how this is going to impact Afterpay and how this is going to change the organization.
Look, I'll go first. I'm sure Johnny's got some ideas that we can stay with the current running order. Look, I mean, I listened to the Afterpay full year results last Wednesday, so a week ago, and from Ann Eisen and Nick Molnar's perspectives, business as usual, sort of turbocharged. I think was the right way to think about it. They're still wanting to do more. I think with Square, they're going to be able to do a lot more. As I said, there's it's a bigger company. There are more users. There are more retailers. It lets them sort of go into the US with more scale. It's also got a wider product offering. So I mean, they're sort of one of a number of features that will go into this Square Cash App, but it also has investing and it has Bitcoin and there's stockbroking sort of services in that as well, which is what Afterpay was sort of starting to think about with the creation of Afterpay Money in Australia, which is sort of a deposit holding thing and others to add. So I think they're looking at Square and thinking, this really is going to give us scale, give us reach, and get to work with the likes of Jack Dorsey and a big company that's a lot bigger than ours. So they seemed quite sort of motivated that the story was sort of still had a long way to play out. I mean, I don't know Square as well as I do Afterpay, but I think Square was really struggling to make those connections between its user base and the merchant base. Like it operated in quite sort of like siloed sort of sense. It had its user app, but as I said, was sort of offering users all sorts of bank-like financial services. It had sellers, merchants using its software. It's like a point of sale software, and those little white dongles we've seen in Australian bars and cafes to accept a payment, but it hadn't really brought the two together. So those supportive of the deal, the shareholders who support it, and the guys who are backing these two companies are hoping or suggesting that Afterpay will be the thing for Square that allows Square to bring the two sides of its business together and get those network effects. So we'll see.
Yeah, no, the only thing I'd add to that, and the more wearing my cynic hat on, is that the Afterpay share price in February was in the 160. I think it hit 160, and then this deal was struck at 130. And there were a lot of analysts, and it's hard to fault their logic, was saying, look, this is going to become commoditized. Afterpay is going to grow, like it is going to grow their revenue, their sale, like the extent that Afterpay is used, and the revenues and the sales that are done through Afterpay is going to grow, and it's going to grow exponentially, and the market's going to grow, and Afterpay is going to grow its share of market. But what they were doubtful of was whether Afterpay could continue to charge like an average of 4%, a merchant fee. So they figured that would have to come down with more competition. And as they got bigger and started processing sales beyond fashion, into electronics where the margins are lower, they just saw that coming down. And the thing is, if it comes down, Afterpay is not, it's already not profitable, but without that 4%, if 4% becomes 3%, they become a very low margin business, no matter how big they are. And it's very hard to justify a valuation. And I think the deal kind of saved them from that potential fate. Whether it would have happened or not, there's a division, but they don't have to. It removed that, what some people thought, inevitable kind of force of competition weighing down their pricing, destroying whatever thin profitability they had anyway. And then Afterpay becomes like as James explained, a plug-in for a bigger, more powerful, square that is both sides of the merchants. Then it becomes worth $39 billion, but on its own, there was a very real open debate whether Afterpay was worth that on its own, doing what it continued to do. So that's my perspective on the Square deal.
Yeah, well, it will be very interesting to see how that pans out over the few years. But just back onto the book, I mean, just saying one thing, it's a very well-researched book, and some of the feedback that we've been getting from our subscribers is just how in-depth some sections are. Great. So I'm interested to hear, what are some of those insights, or what are those most interesting points that you uncovered while researching the book?
Do you want to start with that one, Johnny? Or...
Yeah, okay, I'll start. I feel I can start with that one. I was hoping for some thinking time, but I guess you've given me the thinking time in the last few questions. Look, one thing we discovered, which we wrote, we landed up, we couldn't actually keep it under our chests for till now, which is this the history of Touch Corp, the company that owned 30% of Afterpay from the get-go, because they kind of built the tech, and they built the tech in next to no time, which makes me think it wasn't that difficult to build. But they got like 30% of the company for doing that. The founder of, one of the founders or CEOs of Touch Corp, Adrian Cleve, owned a lot of shares in his personal name. And he tragically passed away not long after Afterpay listed. So they still owned a big chunk of Afterpay, and it all bequeathed to his widow. And it became this very big kind of difficult fight between, he comes from an Irish Catholic family, so he had 27 nieces and nephews, and some of the shares were held in the family trust, and then his widow, and it became this battle over the shares. And as Afterpay was going up and up and up and up, it became a battle over about $1 billion. I think it's just over $1 billion, which landed up getting split evenly. I thought that was pretty fascinating. The thing for me that I found interesting, because I came from it with a kind of a cynical, I don't know, I could be cynical, but a kind of is like open-minded as to not that this thing is the next big thing, like, is it going to succeed or fail? I was very much sitting on the fence, but interviewing a lot of investors in the market, how convinced they were of that it would work, that they really trusted the founders, Anthony and Nick, and the idea. I found that quite interesting, how steadfast a lot of the early investors were. Not all of them. Some of the seed investors got out at the first opportunity. Those are some of the interesting things. I mean, what we didn't know, but maybe didn't appreciate the extent of, was the kind of near-death experiences. Like, actually one comment I got from someone that read the book was that this was not a simple buy and hold, Afterpay, buy shares. And there were moments where it was very justifiable that you sold them. And there were moments within the Afterpay camp that they really were staring into the abyss, and if they didn't respond or move, they would have been in trouble. The other thing, this is something we knew and we wanted to spell it out, but it was still surprising, is like the mechanizations of Canberra and the politics and all of that. That was
I was going to come in and say that. And we've gone like a chronological with John answering that question first and then me. But if you come back sort of 3 years, 2018, 19, though the political machinations were really fascinating. I mean, as we sort of researched the book, it became clear that the Afterpay guys were just, fantastic at the lobbying game. They really, took it to the banks. It's something the banks were pretty good at and took it to another level. I mean, Anthony Eisen spent a lot of time in Canberra talking politicians through the model, and the amount of economic research that was commissioned in their favour and used to support them, and then the way in which the guys sort of would attend these Senate committee hearings and explain the model and convince the public and convince the politicians and the media and sort of sell the story. Was quite amazing. I mean, the May 2019 election, I think, worked as a massive sort of tailwind for Afterpay. Everyone thought Bill Shorten was going to win that election, and just before that election, the tone of the Senate committees that were looking into Afterpay were very negative. They were equating Afterpay with payday lending, and they were probing into fees, and the consumer groups were shouting from the rooftops about people not being able to afford the product, and how people were sort of spending on things that they shouldn't be spending on because they didn't have enough income and they couldn't get credit, and Afterpay should be regulated like credit. And these debates are ongoing. By the way, the consumer groups haven't really let up. But then, when Scott Morrison won that election in May 2019, the next Senate committee that was called was very supportive of Afterpay. It was looking at fintech and Australian startups exporting, and how do you encourage technology jobs and all this sort of stuff, which really played into their favour, as Labor and the consumer groups were sort of took a back seat for the term of that government. And I think as a result of that, the regulators sort of stood down. ASIC were doing reports into Buy Now, Pay Later, and were looking at the late fees, and they were sort of quite critical reports. And then a couple of years later, the reports, ASIC reports, still identifying issues with Buy Now, Pay Later, but no real response. The regulators are fairly meek, stand down, let these companies grow, and really was fortunate, I think, Johnny, that Labor didn't win that election. It might
that's Sunday. That's kind of a subplot in the book, which again is not Afterpay specific, and the election was the key moment. We just had this complete kind of turn in the regulatory environment. It just became from banks being on the back foot and to like a very kind of laissez-faire, let these things grow. And Afterpay, I think, was a benefactor in that, and almost to the point where you can see regulators that are supposed to be kind of fearless, kind of changing their tune and just having to get the memo from Canberra and literally doing exactly what you think the memo would say, which is like, stand down, leave these guys alone, give them more time. Which is this, to be frank, I think it's, again, not specific to Afterpay, it's quite disconcerting, to see the regulators doing exactly what the government wants to do, rather than showing a kind of independent force about what they need to do. It's getting a brief and acting on it, which it's an interesting time for regulators, that's for sure.
Yeah. And what are those really surprising things that came out from the research? Is there anything that you've thought of before going into writing the book, and then when you did your research, you completely, you're really surprised by it?
Yeah. What do you reckon? It's a tough question. I can't sort of think of anything that was, maybe I should have sort of thought about something that's really surprising. Got to help me here, Johnny, if anything comes to mind.
The Target Clubs, maybe. They were quite how aggressive the Target Clubs were in going into Afterpay. I don't think that's something we appreciated. There was this very controversial deal in 2019 where Afterpay raised all this money and the founders sold a big chunk of their shares into the market. And the next day, Austrac, the financial intelligence agency, comes out and says, we're looking into Afterpay. And it was a big scandal. How could they raise money and the founders sell millions of dollars of shares the day before Austrac kind of slaps them across their wrist and tells them that they're going to do this 6-month investigation into them. And I guess probably what we didn't appreciate is that the shares were sold to these 2 hedge funds in New York who are about the savviest. They're not the guys you pull the wool. They're not the guys you take advantage of. They were keen to own a lot of Afterpay. And one of the interesting insights was one of those hedge funds had done some research on college kids in America and found that they had 86% recognition amongst college girls in America knew what Afterpay was, and they hadn't seen that number since Facebook. So they were like, that was enough to inform them to go as big as they could into Afterpay. Now, they had full conviction on that front, and they were also, yeah.
No, it was interesting, Johnny, sort of talking about that Tiger Cup history, because that was actually truly a surprising thing. Like reporting about Afterpay from here, like we knew that they had some US investors who were coming in, and I mentioned Tencent earlier, which is Chinese investors. So we sort of had this sense that the big, US investors were interested in Afterpay, but I didn't realize, Johnny, just the amount of work that those Tiger Cub funds had done on Afterpay in terms of kicking the tires, and just how big those funds are. Like these guys were, the very early investors in Apple and all of these companies, and had moved together into Afterpay in a really big, confident way. In terms of surprise, I mean, I'd followed the major banks here for a few years, so it wasn't surprising that the major banks had responded to Afterpay in the way that they did. But I suppose as we did more research for the book, it did become apparent just how serious Commonwealth Bank, especially, and also the other banks, took the threat. I think when Afterpay was sort of listed and started to scale and grow, if you're a large bank in Australia, everything's really small. Everyone else is pretty small compared to you. And, how big do you need to get to move the dial? And I didn't really appreciate that Afterpay even got that big with 3 or 4 million Australian customers, and they were focused on the US. And I was surprised at the extent to which their growth was resonating inside the CBA and forcing big competitive responses by these incumbent institutions.
One other surprise, I should say, is when Afterpay was going up and up, the share price week, and we're covering the small caps, and the micro caps, you often see a lot of stocks that the market just kind of, for lack of a better word, just pumps, like the stockbrokers get involved, everyone's cheering it up, and you almost seems like a bit of an inside job, like everyone gets set in their position and everyone just talks this thing up. And I probably thought there was an element of that with Afterpay, but in kind of going back and talking to these investors, you realize it wasn't like that at all. That even though the share price was going up and up, there was so much, even within like some of the most supported stockbroking firms like Bell Potter, like there's a guy, Richard Coppelson, who's known for being a bull and being like a big, and you sit outside and think he'll just kind of talk. You could be forgiven for thinking he'll just talk anything up, that. But it wasn't like that at all. I mean, he discovered it by accident, getting an Uber, and Nick Molnar's dad picked him up, and he wasn't convinced. And it was only then that he kind of did his work. And the analysts there, they all needed to get comfortable with it, and not everybody did. So it was not like you see a lot of these small cap stocks where everyone embraces them.
Yeah.
That's
okay. That's okay.
Hold on.
That's all right. So James, just on to you. So at the start of the book, you mentioned that the founder, Nick and Anthony, didn't want to be part of the book. They actually mentioned that they would offer their time and then connect you to the right people, but didn't want any of those, on record conversations. So now that the book has been published, have you received any feedback from them?
Oh, look, I asked them about that last week. I mean, to be honest, I think they've probably been too busy with this Square deal to sit down lie down on the bed and read the book. I think they were pretty interested in it, though. They said that they'd had some requests from family members and friends and stuff to have a look at it. But no, haven't really heard from them specifically and directly about anything. I mean, I sort of take that as good news in a way. It's been out for almost a month now, so
it'll be a month soon.
Yeah. So I'm sort of I'm pleased in a way that you haven't received hot phone calls.
We're in the clear now, James. If we've made
surprises. But we did try to sort of do everything pretty accurately. And as you said, I think when we approached them in January this year, which was, we were in the middle of the writing process then. And, you know, they I don't know if it's because they had this Square deal in their mind then and they didn't want to talk about it or couldn't talk about it until it was done.
Yeah.
It sort of tried to fob us off and tell us it was too early to do a book. I'm not
I think
sure
that's
about
what
that.
helped us.
It might
Should
have
have
been
given you the
something
hint.
about that, but they
They
just
should have
thought
told you
that,
to wait until August.
yeah, and then it never would have happened and stuff. So I'm glad we put the foot down regardless of their willingness to assist. I think they just thought it was well, they told us that they thought it was too early, you know, to write the story, and they hadn't even conceived of someone coming to them with the idea that we had. So I think it sort of took them a bit by surprise, and you know, now that it's out, I'll look. You know, I'll be interested to hear what they think about it.
I've just got. I had a couple of texts from Ron Molnar, the dad, because he asked me to drop him a book the day or a few days before it came out, and he said he'd read up to halfway and said it brought back a lot of good and bad memories. So I think we're in the clear there. But yeah, look, I mean, this was an interesting thing. We wanted to be totally fair to them. Like, it's quite confronting someone writing a book about you, even if you're a founder of a $39 billion tech company, is still kind of conscious of, you know, writing about somebody in their life and their family. But so we did everything we could to make sure we were fair and accurate. But then again, they're only two of an audience of, you know, many. So we thought we wanted to be fair to them, but we wanted to tell a proper story for readers, and we were confident either way that what the story we told, most people would it'd be fair. Like, most people wouldn't have an issue, even if they were maybe a bit sensitive on certain things. We didn't think it would come across badly, but we also didn't want to write a herogram to them either. And I think hopefully we've achieved that.
Yeah, and as you've said previously, Johnny, like, even though the book sort of is about them and Afterpay, when we were writing it, we didn't sort of really want it to be too much about those guys and Afterpay as much as everything else that the company was impacting around them, you know, including the stockbroking community and the investors and the banks and the regulators and the consumer groups, as we've discussed. So we almost told it from the outside in, and just sort of used them to make sure we had our facts right, asked them lots of questions. We got back responses. They helped steer us in the right direction with respect to talking to relevant staff in Afterpay who, you know, we wouldn't necessarily have known were the movers and shakers, but they, you know, made some helpful connections with those guys and did that sort of thing. But we didn't want the project to rely on them sitting down with us for hours and hours and hours and opening up the company to us. We wanted to be able to do it, even if they said at that initial phone call, no, we're not going to help you. We think we still would have had a book to write. I'm glad that they did assist us, because I think it's a better book. It landed in
the perfect place for us, between them helping us but not endorsing it, and us being independent and allowing. And look, one day Nick will write a book and it'll have all the details, and there'll probably be a few pages on those pesky journalists that hassled him about a book when he was about to sell his company. So, and he'll probably talk about the negative and positive media that he got, because like Afterpay get a real mix of media commentary from our paper and others. So I'm sure you'll have a lot to say on that. But I mean, one of the great things about a book is you can take a step back and tell a long arch of a story, rather than get stuck in the day-to-day where you have to, because everybody knows the story up until now. So every news article has to be incremental and significant. But a book, you can piece it all together. And that was a fun thing about writing a book, is like something that happened in a bar in 2017 wouldn't have had any relevance. Even the two people that met there, you know, they would have walked away and wouldn't have been even the highlight of their day. But, you know, now in a book, that kind of meeting like that becomes like hugely significant for both of them and for Australian finance. So that's the fun thing about a book. You can revisit things and events and people and places that, you know, take on a whole new relevance because of what's happened since.
Yeah. And throughout the book, you can see there was a lot of references to the AFR. So I'm sure you guys dug into all the articles that you had available and pulled from there. So I'm interested to hear about what's next and coming up for you guys. Is there any other startups that are on your radar and you'd be interested to write about?
James?
Yeah, I wouldn't sort of name a name. I mean, I've sort of been taking a bit of an interest in, in the rollout of the blockchain technology, and sort of looking at themes around decentralization of, financial services, and how trust is sort of changing in an economy where you don't need to have intermediaries as much as you did in the past. And so, there's lots of startups in that space. I haven't come across anyone that would, warrant a new book, or be the next Afterpay. But I think there's a lot of interesting startups around the place, and I think there's a lot of demand for people are interested in the stories. But no, I'm not. I don't know. I don't know if I could if I put 300 pages together on any of them just yet.
And a lot of people mentioned two companies, Atlassian and Canva, and which both, I think, Atlassian absolutely has created more wealth than Afterpay. I think it's an $80 billion US company, and Cannon Brooks and Scott Farquhar worth 20 odd billion, so almost 10 times more than Molnar and Eisen. So on the numbers, that's a bigger story. But I personally cannot get excited in it. I've read lots of articles about what Atlassian does, and I still can't tell you what they do. I sort of can. It just and it's taken place in private. There hasn't been any controversy. There hasn't been this exciting mix of retail investors debating the stock and consumers using it. It's probably a few IT guys that are debating the merits of some of the Atlassian products. And Canva a little bit similar. It's like an enterprise software thing, although I know there's a retail element of it. And Melanie Perkins is always smiling and has no reason other than to just smile because everything seems to have gone swimmingly, whereas I don't think it's been that way so purely as a journalist telling you
need a bit of tension.
Yeah, telling a great story, and
story.
That's a credit to Atlassian and Canva. It's not a criticism. It's a kind of a credit to them that their journey, at least from the outside, I'm sure from the inside maybe not, but it has been quite smooth, and it's taken place in private markets and on the NASDAQ with limited controversy and tension. So I don't think you learn as much about the world from those two stories. Maybe you do a little bit, and no doubt those founders are probably best placed to tell the best story of Canva and Atlassian, not a journalist from the outside. I don't know. I think there's always interesting stuff going on in Australia, and always interesting companies. But I think it'll be a while before a story as interesting and divisive as Afterpay comes along. But I'm sure they're out there, or there'll be one soon enough.
Awesome. Well, thank you both for your time today and coming in and having a chat. Is there anything else that you want to add on the story, or maybe plug on, where readers can go find the book?
I think you can find it in most places. Most independent bookstores will have it. I think you've got to phone them first and click and collect. Booktopia, Amazon, Book Depository. And I just hope people read it because there is a lot more to it than Afterpay. There's a lot of stories about, for someone, I guess, getting interested in finance. Hopefully, there's little kind of subtitles in there about how markets work, how finance works, how companies are built, and the beauty of Afterpay is it happened in such a short time frame. So we could we didn't have to jump and leave out a lot. So hopefully hopefully there's more than just a story. There's a bit of an education about markets and finance.
Yeah, that's well said. Thank you, Marco, for your interest in the book. And I hope the members of your club enjoy reading it.
Yeah, and they can send us feedback as well. I'm sure you can find us on LinkedIn and Twitter. I love hearing about feedback, good and bad. And if anyone has any questions about the book or Afterpay or anything related to our coverage, we're always happy to engage with anybody.
Absolutely. Thank you so much for your time. Thank you.